Good, good morning, Las Vegas, and welcome to the Manage Your Money workshop for the sponsored by the 100 Black Men of Las Vegas. And also, we'd like to thank our community partners who help us with this event: Nevada Partners, Coalition of 100 Black Women, Urban Chamber of Commerce, Bank of Nevada, Wells Fargo, and of course, the 100 Black Men of Las Vegas. I'd like to introduce to you today the CFO of the 100 Black Men of Las Vegas, Mr. Daryl Rayford. Daryl, take it away.
Good morning, everybody. Good morning. I am so glad you were able to cut out a little part of your weekend to share with us on financial knowledge. And today we have two distinguished guests who have taken time out to help us understand investments. It's very important for us to get more involved in understanding how money works. And today we have two gentlemen, one gentleman by the name of Jason Baucom, I hope I pronounced that right, Baucom, and Christopher Nolan. They both come to us from investments companies. I'll let them tell you their stories. They're licensed in Nevada and California. I'll let them tell you the stories, but first we'll start out with Christopher Nolan. Christopher, you got the mic.
Thank you, Daryl. Yeah, good morning. My name is Chris Nolan, and I'm chairman of the Nevada Council for Economic Education, where we focus on financial literacy and economic education for youth grades 3 through 12. And those programs include stock market game, as well as the Invest Right competition. And we have a few other great programs for our youth to help educate on financial literacy. My day job is the founder and president of General Manhattan Financial and General Manhattan Insurance and Benefits. Happy to be here today to help educate you all on investments. Jason is going to go first and with his presentation, and so I will see you thereafter. So Jason, go ahead, take it away.
Good morning. I'm Jason Baucom. I'm a financial advisor locally here in Las Vegas, Nevada with the Buden Group and LPL Financial. I've been in financial services working there for 18 years, bring a vast array of background and knowledge all the way from checking accounts to mortgages to investments to insurance. So I cover the whole gamut. I have 18 licenses in terms of registrations in 18 different states across the country, as well as 5 different professional designations. So I'm well advanced in investments, and I hope I'm able to share some knowledge with you, and you can walk away feeling better about your situation and making a difference in your life.
And let me ask both of you a question before we get started, Jason. You both have information that you could post here if somebody wanted to contact you at the end?
Yes.
Wonderful. Okay, let's rock and roll.
The road to retirement and beyond. Why did we select that as the topic for this? The reason why is because it is going to take not only like a road trip. You're going to start. If you start in LA and wanted to get to New York, you wouldn't just go. You would plan. Think of your life like that. The next 40 years of your age 20 to age 60 as a giant road trip. There's going to be some potholes along the way. You may have to change a tire. You may have to get some oil changes. You may have to double back. You may have to go a little faster in some areas than others. So keep that in mind. The opportunity is going to be there for you as an investor to make some changes along the way. It is a giant road trip. You can sometimes see me locally on Financial TV here on the Financial Focus on Channel 13 Action News. I'm a irregular commentator on there in terms of, it's not on a regular basis, but do come from time to time, and I'm on there as well. What we're going to cover today: budget, investment vehicles, retirement timeline, compound interest, inflation, tax diversification, income in retirement, estate planning, and we'll take some lessons from history and see how we can use that for the future. Financial planning process. Where does it begin? Well, when you sit down with a financial planner or advisor, we have to gather important information. We want to help you understand, we want to understand your needs. We first gather important information and establish short and long-term goals. Goals provide checkpoints and targets to hit. We evaluate their situation to see if the goals are realistic based on their time horizon. Is it 5 years, 10, 15, 20, 40, 50? Then we match up the risk tolerance and begin working on a financial plan. During annual meetings, we update that plan to make sure it's still within the short and long-term goals and their focus. Things do change along the way, and we're ready to help. Helping clients complete their financial puzzle one piece at a time is very important. Our goal is to help clients do that, and everyone's financial puzzle is different and customized to the investor. Some plans have more or less puzzle pieces than others. So the ultimate goal is to have a portfolio that's completely diversified. Is it realistic? Can it be? Yes, with tax diversified investments on the inside and insurance being used as protection on the outside. We know that most investors will not have an equally weighted portfolio, and that where we can help them balance it toward their long-term goals. He who plans to fail is planning to fail. He who fails to plan is planning to fail. Winston Churchill. Getting to and living well in retirement is no accident. Not being prepared worries a lot of people. Think about all the planning that's required for a 2-week or 4-week vacation. Passports, gas, rental cars, meals. Do you do the same intense planning for your retirement? If not, why not? Investors fear they're not ready for retirement. And that fear about investing now leads to anxiety about the future and your retirement, making you feel like you would never be able to retire when you thought you would. This slide shows concerns that investors have about retirement. 58% of investors worry about not having enough money for retirement, and 48% of investors worry about not being able to maintain the standard of living they enjoy. Now more than ever, investors need help. We're here for them. So what's the solution? We believe that, yeah, you can retire how you want to and the quality you want to, but it does take some intense planning. Let's take a look at the perspective on some short and long-term financial goals. And after we find that out, that's how we're going to know we're going to be able to get you there. So financial goals to start with, you're looking at emergency plan. The COVID-19 pandemic hit us unexpectedly last year, and the economy suddenly stopped last April. Were you prepared? Many people panicked when it happened because they lost their jobs. This is where an emergency fund could have helped calm their fears. Most experts believe that you should have enough money in your emergency fund to cover at least 3 to 6 months worth of living expenses. By eliminating debt, you will not be paying someone else interest, and it allows you to have more capital to invest. At some point, we all want to retire. As we get older, we see that goal getting closer and closer, but are we prepared for it? Do you have the right insurance in place to protect your financial portfolio from hiccups? Do you have the minimum insurance required, or do you have an umbrella policy that covers more than one thing? Do you have life insurance in place to protect your family in case you have untimely demise? Last but not least, do you have multiple sources of income? All these goals begin with the budget. What goes into your monthly budget? A typical monthly budget is going to have health and medical, transportation, entertainment. Some of these items can be found in most budgets. Of course, these 10 items are some of the most common things we see in most people's budgets. But what are we missing? We have mortgages on here, insurance, credit cards, loans. But what are we missing? These are all things that are here for today. Or are we thinking about tomorrow or beyond? Things that are missing from your budget are typically around retirement planning. The monthly IRA contribution, IRA stands for Individual Retirement Account. Are you maxing out that monthly contribution to add up to the annual maximum? What is it? What is the monthly contribution? What is the annual maximum? Are you taking advantage of your employer offered 401k plan and matching contribution? For example, if your employer is offering a 401k with a match of 5% of your salary, are you contributing 5% to get that match and double what you're saving for retirement? Not all 401ks offer a match, but if you are participating in one that does, you definitely want to do that. If you have questions about if your retirement plan does, your 401k at work does, ask your benefits administrator. They'll point you in the right direction and offer you some help. Getting help earlier in your plan rather than 10 or 15 years later makes a huge difference. In your monthly budget, are you actively contributing to an emergency fund for yourself? Are you saving money for taxes so that you're not hit with an unexpected tax bill the following year? Let's take a look at some investment vehicles available to help everyone that has income. Traditional individual retirement accounts versus a Roth individual retirement account. One of the biggest differences between the two is how contributions are made. In a traditional IRA, contributions are made for pre-tax income. In a Roth IRA, contributions are made post-tax. What does that exactly mean? They both have the same contribution limits of $6,000 a year for investors under age 50, and those investors over age 50 can contribute up to $7,000 a year. Because you do not pay taxes on making contributions to a traditional IRA in the beginning, you must pay taxes at distribution. So it becomes a delayed tax bill. In a Roth IRA, taxes are already paid at the beginning, and there is no tax liability when you withdraw the money at age 59.5 or beyond. There's also no required minimum distribution. I prefer the Roth because of the tax certainty in retirement. Some other investment vehicles you have the opportunity to invest in or use are a 401k and a 403b. Yeah, that's a lot of jargon there. The 401k and 403b are just IRS tax codes. Some key takeaways for this are 401k and 403b plans are qualified tax advantage retirement plans offered by employers to their employees. 401k plans are offered by for-profit companies and corporations to eligible employees who contribute pre or post-tax money through the payroll deduction. 403b plans are offered to employees of nonprofit organizations and government organizations as well. Lots of teachers are eligible and contribute to 403b plans. Nevertheless, 401k and 403b plans are very similar as far as retirement vehicles go. Both have the same basic contribution limits, both offer Roth and traditional options, and both require participants to reach age 59.5 before taking distributions. We have discussed some investment vehicles, but what goes in them to help you achieve your goals? There are a lot of ways to save your hard-earned money and accomplish your financial goals. You want your money to have the possibility of growing over a long period of time. You may want to consider investing in stocks and bonds. This approach will depend on your personal situation, including factors such as your goals, your risk tolerance, and your time horizon. Risk tolerance is just another way of saying, how comfortable are you with changes in the market? When things go up or things go down, do you panic or do you get excited? How emotionally tied are you to it? Time horizon refers to length of time you plan to invest. Purchasing stocks or bonds are two common ways to invest. So what is a stock? A stock represents a piece of ownership or equity in a company. So a person who owns a stock is a stockholder or a shareholder and owns a piece of the company. Stocks are considered the riskiest investment of the options listed here. Nevertheless, it's worth noting, even with this relatively risky investment class, some stocks are considered safer than others, though the potential for loss always exists. As a company's stock goes up in value, so does your piece of the pie, and vice versa when the value of the share goes down. Sometimes stocks offer dividends. A dividend is a regular payment made to a shareholder. A company we are all familiar with is McDonald's. No, I'm not endorsing them at all. I'm just saying it's just an example. McDonald's is currently paying an annualized dividend of approximately 2.2%. So annualized meaning over a year, 2.2%. So for every $100 of McDonald's you own, they will pay you $2.20 just for owning their stock. That dividend payment can be taken in cash or used to reinvest in the company and purchase partial shares of stock in the company. So you become a owner of a larger piece of the pie. It's important to note that there are many different types of stock, all with different characteristics. Before you invest, make sure you fully understand what type of stock you're purchasing and all the risks associated with it. That's where you come to a guy like me and we sit down and explain it. Now, let's discuss bonds. You can certainly see on this little chart here, the higher risk is toward stocks, the complete lower risk is toward cash equivalents, and bonds are somewhere in the middle. Purchasing a bond is essentially loaning your money to a corporation, city, organization, or government for a fixed period of time. In return, they'll pay you some amount of interest. The borrower issues a bond with the terms of the loan, including the amount of and schedule of interest payments and the date on which the principal, that's the initial amount invested, must be paid back. When you hear about a date it's being paid back in a bond, that's called the maturity date. The value of a bond rises and falls with the market interest rates, so it's possible to lose money when selling a bond. Bonds are generally considered a less risky investment than stocks. There are many different types of bonds, all of which work differently, and we'll get to those in a minute. Before you invest, make sure you fully understand what type of bond you're purchasing, all the terms that come with it. What if you want to invest in stocks and bonds simultaneously? Can you? Absolutely. That's where mutual funds come into play. A mutual fund is a professionally managed collection of investments, generally a combination of stocks and bonds. This collection of investments is chosen by a fund manager and purchased at once. Because the risk is spread out over many investments, mutual funds are generally considered less risky than investment in a single stock or single bond. It's important to remember that you're taking on risk with any investment. And let me repeat that, any investment has risk because you're never guaranteed a positive return. Now, when you're watching one of the business channels, you see many lines near the bottom of the screen scrolling from right to left, filled with acronyms and numbers. I think it can be really confusing. There's a lot going on the screen. Well, the stuff scrolling across the bottom represents typically stocks. And you'll see in this example, we're looking at Microsoft, MSFT, that acronym for Microsoft. If you were buying and looking at this right here, buying stock, you would be purchasing 5,000 shares, that's the number of shares traded, of Microsoft at $61.25. That total at 5,000 multiplied by 61.25 comes up to $306,250 worth of stock. At the time of the purchase price went down $1.35 from the market open early in the morning. Next time you're watching a business channel, you'll know what you're looking at. You'll see the ticker symbol, you'll see the price, and you'll see the change in direction up or down. And you'll see the change in direction by how much. CNBC, CNN Money, Fox Business, Bloomberg, those are four of the more popular business channels out there. And this is when its stock is traded on the New York Stock Exchange, which is NYSE. You will see that as well. Now, I mentioned bonds a little earlier. There are five major types of bond categories: corporate, municipal, treasury, junk, and bond funds. Now, what type of risks come with bonds? All investments, including bonds, come with some type of risk. In this case, interest rate risk, prepayment risk, default risk, credit risk, currency risk, and liquidity risk. A bond, or a fixed income instrument in this case, is used by governments and companies to raise money by borrowing from investors. Think of them as loans. They're typically issued by the government and companies to fund specific projects rather than issuing actual shares in a company. Many of these bonds receive ratings that determine how sound of an investment they are. That ratings chart is on the right. These two categories are investment grade and high yield. Their ratings are like a credit score, except for governments and companies. The better their rating, the lower interest rate you get paid because there's less of a risk. The higher the lower the rating in terms of below investment grade, the higher the risk and the potential for a greater return. So it's a balance of both that you need to look at. It's like when you have a good credit score, you get lower interest rates on your loans. So keep that in mind. Here's some different types of bonds you may hear about in the news. As we talked about, corporate bonds. They're issued by a company to fund expansion projects typically, Research and development. The returns for corporate bonds are taxable, but they typically yield higher returns than government bonds. Municipal bonds. This type of bond is issued by the city or state to fund projects like schools, railroads, and hospitals. These types of bonds have untaxed returns. Most municipal bonds are triple tax exempt. What exactly is triple tax exempt, and how do I get some of that? They're exempt from local, state, and federal taxes. There are two types of municipal bonds: general obligation and revenue bonds. General obligation bonds are bonds used to fund projects that don't produce income, but rather add value to the community, such as a playground or park. A revenue bond, our bonds are expected to create income, and they pay back the investors with the income they do create. An example of revenue bond is a new highway. The revenue from the tolls on the new highway would become returns to the investors. The yield on a revenue bond is typically higher than on a general obligation bond. Treasury bonds. These bonds are issued by the United States government. They are considered risk-free. Because of the low risk, they do not yield high returns, and any income is taxed by the federal government. Junk bonds are simply low-rated corporate bonds. They may offer higher returns, but the higher returns with a higher risk may not be worth it. Bond funds. Now let's say if I took all these and combined them. They're essentially mutual funds of bonds. This is a group of bonds that's held under one fund. This way you're investing in a portfolio of bonds rather than just selecting one specific bond. Bond funds can also contain multiple types of bonds: corporate, municipal, and treasury. The benefit of a bond fund is that it minimizes risk. By investing in multiple bonds, there is a higher chance of a greater return. On the flip side, these bonds are professionally managed, so you will likely have to pay a management fee. So keep that in mind. Now, what if I wanted to combine those stocks and bonds? We talked a little earlier about mutual funds. A mutual fund is a professionally managed collection of investments, generally stocks or bonds. This collection of investments is chosen by a fund manager. Investors can purchase one or many shares of a mutual fund. Because the risk is spread out over many investments, mutual funds are generally considered less risky than an investment in single stock or single bond. Money market funds. These funds invest in short-term fixed income securities such as government bonds, treasury bills, bankers' acceptance, commercial paper, and certificates of deposit. They're generally a safer investment with a lower potential return than other types of mutual funds. The money market funds may not keep pace with inflation, and we will hear about what inflation is a little later. Bond funds. These funds buy investments that pay a fixed rate of return, like government bonds, investment-grade corporate bonds, and high-yield corporate bonds. They aim to have money coming into the fund on a regular basis, mostly through interest that the fund earns. High-yield corporate bonds are generally riskier than funds that hold government and investment-grade bonds. Equity funds. These funds invest in stocks. Another word for stocks is equity. These funds aim to grow faster than a money market and fixed income. So there's usually a higher risk that you could lose money. You can choose from different types of equity funds, including those that specialize in growth or income stocks. Balanced funds. These funds invest in a mix of equities and fixed income securities. They try to balance the aim of achieving higher returns against the risk of losing money. Most of these funds follow a formula to split money among the different types of investments. Now, why is that important? They tend to have more risk than fixed income funds, but less risk than pure equity funds. Aggressive balanced funds have more equities and fewer bonds, while conservative balanced funds have fewer equities relative to bonds. So you can certainly see it's a mix and match, and the fund manager moves it back and forth depending on how market conditions. Equity index funds. These funds aim to track the performance of a specific index, such as the S&P 500, which is 500 of the largest companies out there. The value of the mutual fund will go up and down as the index goes up and down. Index funds typically have lower costs than actively managed mutual funds because the portfolio manager has less to do. They're just tracking indexes. So with that being said, you'll hear companies like Vanguard, Fidelity, they do a lot of in the equity index fund space. No, I'm not endorsing either one. I'm just providing you an example. So when you see that in your 401k, you know what they're looking at there. So with that being said, we've talked about stocks, bonds, and mutual funds. What types of investments are right for you? The answer depends on your risk tolerance, your investment experience, your time horizon, and the amount of money you want to invest. We're always going to come back to that as a determining factor when we make any investment decision. This pyramid is an example of the least amount of risk being in blue and the most amount of risk being in red. Most long-term investors stay in the yellow with a moderate risk and stick to the blue chip stocks. When you think of blue chip stocks, think of things that you're familiar with, like your phone. What kind of phone do you have? Probably an Apple. Where you shop? The big red store, Target. Where you eat? Or sometimes when you need fast food, McDonald's. The car you drive? Tesla. The home improvement stores you go to make your house pretty and fix things up? Lowe's or Home Depot. Those are just examples of blue chip stocks. Not an endorsement of any of them. Just an example of some blue chip stocks that are out there that you're very familiar with. Depending on how many years you have before retirement helps determine what investment portfolio will look like. You can see here how this chart shifts from the growth to the far left to fixed income over time. So years before retirement to years after retirement. As an investor gets closer to retirement, they want more certainty in their portfolio. So that you can see the shift. You'll hear this referred to in the news as a glide path, a life path, a target date series, because there's all a goal in mind of retirement and beyond. So keep that in mind. Chris, you out there, buddy? Chris, would you rather have
I
$1 million?
am.
Okay, great. I have a question for you.
All right.
So now we've talked about a few things. We've talked about stocks, bonds, mutual funds, types of investments, and investment vehicles. Let's shift our focus. Now we have all this money. Would you rather have $1 million today or a penny that doubled for every 30 days?
Well, Jason, $1 million today sure sounds great. A lot better than a few pennies. I think I know the answer to your question, but I'm going to say $1 million today.
Well, yeah, I mean, I would totally agree with you. You give me $1 million today, I hope to go swimming like Scrooge McDuck. I
Sure
want to
sounds
have
fun.
that. Yeah, I want to have that million. But what does the math tell us? Let's take a look. If a penny doubled every day, day one, you start with a penny. You can see what after a week, you're up to 64 cents. After 2 weeks, you're up to $81.92. This doesn't sound like a good deal so far. Then after 3 weeks, it keeps doubling again. And you can see you're at day 21, you're at $10,000. That's good. But what if we keep doubling that 10,000? Now at the end of 3 weeks, you're at 1.3 million. Then after 30 days, you're at 5.3 million. So doubling your money. Wow. Every day for 30 days. That's amazing. I'd love to do it. I'd actually like to start with 10,000 instead of a penny and see where it went. So Chris, yes, thanks. So let's talk about the time it takes to double your money. It's called the rule of 72. If you decide you just don't want to invest, you need to understand how those decisions will impact your money and your savings. The rule of 72 helps you understand that. If you're going to be in just cash, then it would take a very long time for your money to double, as opposed to the amount of time it would take if your money was to be in stocks or bonds. So as we see here, this hypothetical scenario, if your money was in cash, you would take that 72 and divide it by the rate of return. In this scenario, 1%. You can certainly would take about 110 years for your money to double. Now, if you did the same thing in bonds at 6%, so 72 divided by 6, you're looking at 12 years for your money to double. Now, what if we did it in stocks? Let's say 8%. You took that 72 divided by 8, you would come up with 9 years. So the rule of 72, you should see how it applies depending on what time horizon your goal you're looking for. So would you rather have your money double in 9 years, 12 years, or 110? I'll let you do the math. Yeah, there is risk associated with all the investments, but at the same time, some of that risk can be mitigated over long periods of time. Compound interest is the 8th one in the world. He who understands it earns it. who doesn't pays it. So would you rather be paying the bank or the bank paying you? Would you rather pay interest or get paid interest, if you want to look at it that way? So let's look at a realistic scenario here. Compounding interest lets you earn interest not only on your original deposit, but also on the interest you earn on that deposit. It means your original deposit grows much, much faster than it would be by simple interest. In this example, at 5% rate of return on $10,000, it grew by $500 in the first year. So it's 5% of 10,000 is 500. At the end of year 2, it grew by another $525. So that's 5% of that 10,500 is $525. Then at the end of year 3, you're left with $11,576.25, just on a modest 5% growth for just leaving your money in there, letting it grow, leaving it invested. Now let's take that scenario a little further. We talked earlier about an IRA. An IRA, individual retirement account, will have certain parameters will allow you to invest over time. So no matter your age, income, or financial goals, taxes can take a bite out of your long-term savings. That's why it makes sense to make the most of many opportunities as you set aside money in tax-deferred individual retirement accounts and workplace retirement savings plans such as 401ks, 403bs. So as you look at this here, you can certainly see this is a chart showing the IRA. IRA of putting $500 a month away, or $6,000 a year, because that's the current limit for people up to age 50. Over 50, you can invest up to $7,000 per year. So at $500 a month for, let's say, 40 years. So $6,000 a year times 40. So 6,000 times 40 is $240,000. That's what you would be investing over 40 years if you did that consistently. Let's say the rate of return we're averaging 7%. Over 40 years, you take that 6,000 times 40, 240,000 is what you invested. The $240,000 investment would have grown to 1.2 million plus. Is this realistic? Absolutely. But you have to stay invested. Let's take a look at the history of the market to prove my point. This is the market's done over the past 80 years. You can certainly see from 1937 to 2019, it averaged 10.4%. 10.4%. It's good. But it also has, there's some negative, it's negative at times. And during the negative years, the negative 12%. And the positive years have been positive 19. So it averaged out to 10. So keep that in mind. It is possible. Now, all investments, of course, involve risk, including loss of principal. The chart provides is for illustrative purposes only and represents an unmanaged index in which investors cannot directly invest. The data in the chart is based on 260 trading days in a year. So this is the number here. Now, let's take a look over the past 40 years. There's always been a reason not to invest. Over the past 40 years, we had 12 different epidemics, and in each one, people said the market would crash and be unrecoverable. These are all health concerns, much like we're currently in right now with the pandemic and COVID-19. You can see all the way from AIDS when it first happened, to SARS, H1N1, cholera, Ebola, measles, Zika. It's all on here. After each epidemic, the market rose. The best time to invest is in a down market. You have to remove the emotion out of your situation and look at it objectively. That's where you hire a guy like Chris and I, or financial advisors, because we're going to look at it and tell you, hey, it's down. Okay, most likely it's going to go back up at some point. It's the best time to invest. You can buy more shares at a lower price. So we help you make informed decisions. We're not making the decisions for you. We're helping you make informed decisions. And we look at charts and graphs like this in history to help dictate what we're going to do in the future. But history does not guarantee positive results, but it gives us a place to look at and go from there. The probability of positive returns. How long do I really need to stay invested? Some people say, I don't want to invest because I'm afraid of losing money. Okay, I get it. The fear is real. What do the numbers say about that? If you invest for one day, it's a 50-50 proposition, essentially. But if you invest for 10 years, there's more than a 97% probability that you will have a positive return. So long-term investing. We don't day trade, because it can be a losing proposition in a lot of ways. But if you invest over the long term with the focus on long-term goals, there's an opportunity out there to have a positive return. If you tell me I can get a positive, if the goal is 97%, I get a positive return most likely, I would do that. That's what history tells us. When you listen to the news, you'll hear about bull and bear markets. What are they? In a bull market, things are progressing in a positive direction. In a bear market, things are progressing in a negative direction. Bull markets tend to last approximately 6.6 years, while bear markets last approximately 1.3 years. So you can certainly see in the blue are bear markets, and you can certainly see, in blue are the bull markets, and in orange or yellow are the bear markets. So you can certainly see how long the bull markets have lasted there in blue, and definitely recovered from when there has been bear markets. So keep that in mind. They do last longer. So we've talked about bull markets, bear markets, investment vehicles, IRAs, saving money, the maximum you can save. So at this point, how do you know if you've saved enough? So let's take a look at some current retirement savings checkpoints. This is from the JP Morgan Asset Management Guide to Retirement, the 2020 edition. So on the left is your age, and across the top is the amount of income you're earning on an annual basis. Where they intersect is where you should be. So let's take somebody who's age 30, earning $40,000 a year. We're going to multiply that by 0.8. They should have at least $32,000 in retirement savings. Let's look at someone who's age 40, making $60,000 a year. They should have at least $120,000 in minimum retirement savings. So remember, I took the age, I intersected with the dollar amount in income at $60,000. And that's how we came with a 2.0. We multiplied that by the current household income. We got $120,000. The number increases significantly because of the time horizon until retirement. That's 10 less years you have to save until retirement. Now, let's say you're earning more than $90,000. There are a lot of people out there that do. So let's say at age 50, you're earning $100,000. So once again, you go to age, intersected with $100,000, 4.4. You should have at least $440,000 saved for retirement. Now, let's say you're age 60, you're getting ready to retire, you're getting a lot closer to retirement than you were at age 30. And you're earning $150,000 a year. Multiply that by 9.1. You should have $1.3 million saved at that point in retirement. I showed you how to do it. $500 a month, 40 years, 1.2 million plus. So that's one way to look at it. So right on target. Now, let's say you haven't, started doing anything at all. You're like, hey, this is all new to me. I want to do this, but this is all new to me. What do you need to do to catch up? So if you haven't done anything at all, you have no retirement savings, and you begin, and you're age 30, for example, and you're earning $50,000 a year, you should be saving at least 10% of your income, which is about $5,000 a year at that point. If you're age 40, you should be saving 17%, earning $50,000 a year, $8,500 as your minimum catch-up. Once again, that's information from the JP Morgan Asset Management Guide to Retirement, the 2020 edition. Now, what if you're earning a lot more than that and you still haven't saved it because you've just been blowing it, having a great time? Certainly see how this applies to someone who's earning $100,000 at age 40. They need to save 24% of their income to catch up. If you're at age 50 and you have just a little bit more than 10 years to save until retirement, you need to be putting away 59% of your income. Is that realistic? Well, if you want to save retirement, that's what you're going to need to do. You didn't save earlier, so you got to catch up. You can certainly see the model assumptions are on the right that include inflation, retirement savings, and beyond. So that's how we come with that number, factoring in inflation. We're talking a lot about inflation, and these numbers are big. Why do I need to save so much money? Well, inflation erodes your earning power. Inflation is the long-term tendency of money to lose purchasing power. And it can have a particularly negative effect on retirees because it chips away at retirement income in two ways: by increasing the future cost of goods and potentially eroding the value of assets set aside to meet those costs. Think about the price of gas and how it has gone up over the years. The average price of gas in the United States in 1980 was $1.19. It's the same gas we're buying now, buying for 3 times as much. The current average price of gas in the United States is $3.04 as of yesterday. That's an increase of 139% over 41 years for the same type of gas that we used in 1980. It's even cleaner now. It's even refined for less, not more, but we're being charged more, and that's inflation. Now, inflation just doesn't apply to the cost of goods. Let's look at healthcare. One thing that we know you're going to do and have is healthcare. It's something we're going to use in retirement. Now we understand inflation in gas. Looking at healthcare, it applies very similarly. Retiree in 2002 was estimated to spend $160,000 in retirement in healthcare. In 2018, that number rose to $280,000. That is an increase of 75% over 16 years, or at a minimum average of 4.6 years, 6% a year. What are retirees spending their money on in healthcare? You might be surprised, you may not. $280,000, let's look at it. A lot of Medicare premiums, out-of-pocket drug expenses, and Medicare cost-sharing provisions, including co-payments, co-insurance, and deductibles. Every time you visit the doctor, somebody's getting paid. Granted, 50, 60 years ago, you had high cholesterol, you might die from it. Now we just take a pill for it. We can live longer, but we're paying for it as well. You're like, $280,000, really? That much? Our healthcare visits, do you really go to the doctor that much? Well, let's take a look. When you're retired, your calendar begins to fill up with more doctor's visits. You see your primary care physician more often than he or she refers to a specialist as necessary as well. That uptick in general visits is usually attributed to prescription refills. They need to reevaluate the situation and make sure you're still on track. You still see your dentist twice a year, even though you have maybe a few less teeth. The eye doctor's visits increase due to the loss of vision. Now, I wear glasses. I know it's coming. The most common causes of vision loss among the elderly are age-related macular degeneration, glaucoma, cataract, and diabetic retinopathy. Age-related macular degeneration is characterized by the loss of central vision. We all want to see, so we know we got to get that fixed. And also there can be optic nerve damage and vision of field loss. So these things we got to get corrected by going to see the eye doctor. The need for specialists also increases as the body begins to show wear and tear. Hey, that knee that you hurt 30 years ago, you might need to get it replaced now. So keep that in mind. To help offset some of these costs that are known and unknown, some employers offer health savings accounts. Others offer flexible spending accounts, FSAs or HSAs. I'm in favor of the HSA because it's portable and can grow over time. As a type of savings account that is invested in the stock market, lets you set aside money on a pre-tax basis to pay for qualified medical expenses. While you can use these funds in an HSA at any time to pay for qualified medical expenses, you may contribute to an HSA only if you have a high deductible health plan. For 2020, you can contribute up to $3,550 to an HSA if you have self-only coverage. Now, let's say you have a family coverage. You can contribute the max of $7,100. Anyone who is age 55 or older at the end of 2020 could have put in an additional $1,000 in catch-up contributions for the year. There's no required minimum distributions for the health savings account. This is a great way to have money set aside for expected and unexpected medical expenses. To qualify for a health savings account, you must be enrolled in a health plan with a high deductible of at least $1,350 for an individual. So check with your employer and see if it's offered and see if you qualify. If you do, take advantage of it. If you leave your employer, it's portable. It goes with you. It doesn't stay there. So keep that in mind with a health savings account and some of its benefits. So we've discussed several investment vehicles. The strategy many investors use to spread out their risk is called diversification. That's why we talked about so many different vehicles. Diversification is an investment strategy where you choose many different investment types to balance out your exposure to risk. Pairing investments that are risky with those that are not as risky, so you are more protected overall. Diversifying your portfolio is essentially making sure you don't put all your eggs in one basket. Now, as we look here, we see a little bit of tax diversification. Now, why is tax diversification important? In a non-diversified portfolio, we'll look at the scenario here of Mary and John. Mary and John Smith would draw $120,000 from their 401k at a tax rate of 35%, because that's the tax rate they're in. That leaves them a net amount of $78,000. So the $120,000 quickly turned into $78,000. Now let's say it was a diversified portfolio and we had withdrawals from diversified sources. They could still withdraw the same $120,000, but in a different way. They take $40,000 from their 401k at a rate of 35%, ordinary income tax rate. Then they take $40,000 from the mutual fund at 15% capital gains tax. Then they take $40,000 from their cash value life insurance policy, tax-free. Yes, cash value life can be withdrawn tax-free in most circumstances. So withdrawing $120,000 in a tax diversified way, this scenario leaves them with a combined net amount of $100,000. This is why tax diversification is extremely important. This is why you have a CPA. That's why you have a tax advisor. Use them. They'll help you understand how to withdraw money. I use CPAs, I use tax advisors all the time so that I make sure I'm doing the right thing for the client and the client understands what's important and why we're doing what we're doing. So we've talked about how long-term savings over a long period of time, what should be the priority? There's a lot of different options out there. So as we look at here, we start at the bottom. That's one of our initial slide, we talked about emergency reserve, health savings account, defined contribution number 3, that's a 401k. And then as you go up, you're going to want to put money in an IRA and then a taxable account. So using these different vehicles, you can prioritize your goals. Remember we talked about earlier, everybody has a financial puzzle. Every puzzle is slightly different. You're going to go through 1 through 9, but maybe in a slightly different order depending on your experience and your current circumstances. But you still need to stay with the parameters 1 through 9. Let's talk about annuities. Annuity is a financial product offered by insurance companies to provide investors with a steady stream of income in retirement. Now, there's a lot of information out there, good, bad, and different about annuities. What are they? So look at the back of a napkin here. Let's find out. Annuities, investors make a lump sum payment on a series of payments. And the annuity pays a specific amount back to them in regular distributions, either immediately or at some point in the future. These distributions can be used to cover essential or recurring expenses. For example, if you have a $200,000 annuity paying 6% distributions, you're receiving $12,000 a year, or a $1,000 month in income for either a set period of time or for life. So these can help offer you more income, specific desired pension-like income in retirement. The 4 most common kinds of annuities are immediate, deferred, variable, and fixed. In an immediate annuity, you begin taking payments from the account almost as you open it. With a deferred annuity, you can't withdraw income from the annuity for a couple of years to even decades after you've funded the account. You save first, then take income later. A fixed annuity, which has the lowest risk, has a guaranteed fixed interest rate, and your capital accumulates on a tax-deferred basis. Since fixed annuities don't begin paying out right away, they're technically deferred annuities. But unlike a deferred income annuity, you can choose if and when to start receiving payments. A fixed annuity is often compared to a bank certificate of deposit or CD because of very little risk and pays a guaranteed amount. A variable annuity is also tax deferred. You can choose from a group of investments and put inside the variable annuity. Your payout in retirement is based on the performance of the investments you choose. And a variable payout compared to fixed annuities guaranteed payout. So now we talked about income in retirement there, just supplementing a portion of your income with an annuity. So you have a guaranteed stream of income in a lot of cases. 6 key risks to retirement. What are they? Longevity. Living too long. Yeah, outliving your money potentially. Healthcare expenses, inflation, asset allocation, excess withdrawal, being withdrawing too much too rapidly and outliving your money, and lack of tax diversification. Those are some key risks there. Let's talk about more income. So if you haven't done so already, go to this website and register to see what your potential Social Security income could be. SocialSecurity.gov, my account, set that up. You're not turning your Social Security on, you're just merely taking a snapshot of where you are and what you should expect in income in retirement when you turn that Social Security on. It's an estimator which takes the best 35 years of income and provides you with a projection. So the projection on the right in the blue box, age 62, age 66 or 67, and age 70. Why I say 66 or 67? Because that's currently full retirement age. On your statement, you'll see things referred to as FRA, and that stands for full retirement age. Now, some say, well, you know, I'm 40 years old now. Social Security is not going to be there when it's time for me to retire. Is that really the case? Preventing Social Security from collapsing. There's about 10 different ways that the government's going to change something up to prevent it from collapsing. So if they change one or two or do a combination of any of these, will help prevent Social Security from collapsing. So on here, raising the full retirement age. Instead of having the full retirement age at 66, 67, they may raise it to 70. You know, on here, increasing the payroll tax cap. Currently, only the first $142,000 is taxed for Social Security. They could raise that or eliminate that. And that would automatically increase the amount of Social Security. Now, why is this important? When you select Social Security, make that decision to turn it on, it is a choice of a lifetime. You only get to make the decision once. People are living longer, so keep that in mind. As you look at the chart here, you'll see that men have 50% chance of living to 87 and 25% chance of living to 93. Women have a 50% chance of living to 89 and 25% chance of living to 96. Couples have, one person has at least a chance to live, 50% chance of living to 93, and another has a chance of living to 98. So keep that in mind. It's why it's important that you maximize your income buckets. You're like, well, what if I want to take it early? You know, I don't know how long I'm going to live, and I want my money right away. I want to take it to 62. I want my money now. That's what I hear a lot. Okay, that's fine. Go ahead. But if you don't have any healthcare needs, if you're still able to work, and you have a strong family history of health, living in the 80s or 90s, is it the best thing to do? If you delay your benefits, taking your benefits to age 70, you can increase the amount that you're going to have for the rest of your life. And as long as you live to 81 or beyond, you'll be ahead. So at age 62, when you take that benefit, you're only getting 75% of your full retirement age. Full retirement age, you get 100%. And if you wait till 70, you get 132%. So you got automatic increase of approximately 8% a year until you decide to take it. Oh, well, I'm just going to take my Social Security. I'm going to work at the same time. Okay. Are you? Are you really? You could, but for every $2 over that you earn over $18,960, $1 of the benefits are withheld to pay for that. So you're only getting 50% of what you're earning. That changes once you get to full retirement age. The limit also goes up to $50,520, and only $1 is withheld for every $3 earnings above that. Once you're at full retirement age or beyond, that doesn't apply. So as we look at the different stages in life, we talked about retirement. Things change based on your risk tolerance on the left and the investor life stages we go across. So you can certainly see how the chart helps dictate your returns. As you get older, there's a lot of fears in retirees, most feared conditions of late life. Alzheimer's, dementia, which is cognitive impairment, cancer, contagious diseases like COVID-19, flu, pneumonia, stroke, heart attack, These are realistic fears. We know that it's coming, and it all affects us differently of family history. We've seen people pass away because of these different reasons, and we've seen people live out their lives with these conditions. But how do you prepare for some of this? Long-term care. 7 out of 10 of us will have a need for long-term care. 7 out of 10, 70% of us, 65 or older. What does long-term care do for you? Well, it allows for professional care to assist you. It avoids dependency on government programs and limits on your care options. Protects the surviving spouse from financial impoverishment. It also prefers a financial legacy for your heirs and beneficiaries. So long-term care doesn't always mean nursing home. That's the biggest thing that people hear in long-term care. Oh, I don't want to go in a home. Okay. Well, you may not have to. So 51% of people that are on long-term care do it from home. 18% community care, assisted living, adult daycare, and 31% go to a nursing home. But 38% of those people enter a nursing home fully recover, stabilized, and released, end up in home health care. So keep that in mind. So you're like, okay, so who qualifies for long-term care? Well, let's take a look at that. To qualify for long-term care benefits, a doctor must certify that either you have severe cognitive impairment, defined as lack of memory, orientation, person, place, time, abstract reasoning, or judgment relating to safety, severe cognitive impairment, or inability to perform 2 activities of daily living. You heard about ADLs. ADLs is short for activities of daily living. Bathing, dressing, using the toilet, eating, transferring, getting out of bed or a wheelchair, and incontinence. So those are all reasons for people who qualify for long-term care. But remember, you have to have the policy in place before any of these things take place. Another part of your portfolio that you should examine and not overlook is estate planning. To make sure things that go in the direction that you want them, is important to sit down with an estate planning attorney. These decisions you make while you're alive and in good cognitive health, and will help dictate what happens when you aren't or when you pass away. Who do you want to be your power of attorney? Who do you want making your healthcare decisions? Do you have a trust set up? Do you have kids? Do you have multiple kids? Do you have some kids you don't like? Do you have kids that you don't want to give money to at all? These are all different factors when thinking about planning your estate. Do you have a will established? Do you have a trust established? If you have neither, things may go to probate. And it costs the people that you intend for the things to go to a lot of money, because probate is going to court and paying for lawyers to go ahead and litigate the situation for you to get it resolved. So we've talked about a lot of stuff here. We've talked about essentially from beginning to end of the life cycle once you start putting money away for retirement. Now let's look at the timeline another way. So some things we know that are already defined, the pre-retirement timeline. 50 plus. If you want to catch up and put more money away in your 401k or your 403bs, it does increase from 19,500 to 26,000. The earliest you can retire typically is 55 to withdraw money for your 401k. But do understand, if you retire at 55 and you're eligible to, you're probably going to live potentially another 35, 40 years. Do you really have enough money to put away at that point to retire at that age? Most people don't. 59 and a half. When your retirement account withdrawal is no longer subject to a 10% penalty. So what should be done for folks that are about to turn 62? It's time to put a Social Security plan together. Some people want to take it right away. We talked about why or why not. Well, ultimately, if you decide not to collect at 62, it's time to start thinking about how and when you're going to finally retire and start collecting. So keep that in mind. So what's the benefit to waiting to collect your Social Security? Of course, we talked about full retirement age and the increased percentage of income to yourself. 65 is Medicare. If somebody said it blanketly without me knowing any other factors about them, what's the earliest they would retire? I say 65 because that's when Medicare kicks in. You don't want to have to pay all these extra medical benefits and health care insurance prior to 65 out of pocket could be really expensive. Medicare helps offset some of that. So just as not looking at anything else, just looking at, okay, I'm going to save some money. 65 should be your minimum goal before retirement, before turning in Social Security. Of course, you can go later, but you understand that Medicare starts at 65. Full retirement age, we talked about that earlier, and delaying Social Security. RMDs now are changing from 70.5 to 72 requirement distribution from your tax qualified plans. So some helpful hints on your journey along from the road to retirement and beyond. Consult your investment professional. Consult your CPA. Very important for tax diversification purposes. Invest with discipline, not emotion. Invest for the long term, not the short term. Stay diversified. Dollar cost averaging. Dollar cost averaging is just another way of making monthly regular contributions to your 401k as well as your IRA plan. Listen to the news with caution. News doesn't sell good stuff. They only sell bad stuff in terms of things hearing that you're listening to. So remember, listen to the news with caution. Do your own investigative work. Stay true to your written long-term plan. The plan can be modified and changed, but remember your goals. Remember, you don't know everything. You do need help. There's a reason why you go see the doctor. There's also a reason why you go see your financial professional. It's the same reason. You don't know everything. Neither do we. We consult other professionals. That's why doctors refer out to specialists, because they don't know everything as well. But we know who to talk to, and we know sources of information that can be helpful. Now, I took you through and took you back to history, 80 years. Now you're going to hear from a gentleman, Christopher Nolan, guy I work with. Great guy, knows a lot about markets, follows the economy. He is going to take you all the way back to Babylon. Yeah, that's a long time ago, about 4,000 years ago. Chris, are you ready? Christopher?
Yes, I am. Thank you, Jason.
All right, I'm going to stop sharing. It's going to be all you, buddy.
Great. Thank you so much, Jason. That was really informative. And so I'm going to just build a little bit upon what Jason is saying and reiterate. And like he said, we're going to review go back 4,000 years ago. I'm going to share my screen here. So just give me a second. Great, thank you. And before I get started, I just wanted to thank everybody for being here on your weekend, particularly a holiday weekend. Just wanted to give thanks to all of those that the men and women that had lost their lives for us, so we can enjoy our liberty and life and pursuit of happiness. Also wanted to remember somebody else who gave their life for that's George Floyd, keeping his memory going, and so we're able to really have to continue on with the pursuit of equality. We're talking about particularly financial equality, and I think it's great what 100 Black are doing for just to promote education. My passion is around financial literacy for all, and so everybody have a safe and happy and enjoyable Memorial Day weekend. All right, with that, moving on to The Richest Man in Babylon. This is one of my favorite books. It was written in 1926 and goes through it was originally education pamphlets, and it's at 4,000 years ago in ancient Babylon. And so in this book, there is there's 5 rules of gold. And rule number 1, is gold cometh gladly and increasingly quantity to any man who will put by not less than 1/10 of his earnings to create an estate for his future and that of his family. So rule number one is saving. And I can't reiterate this enough. I know Jason had talked about it as well. The number one thing to get you to your future goals is saving. So for future financial success, saving is the start towards building wealth. You can use this savings for such things as emergencies, strategic purchases, investment opportunities, and retirement income. By habitually saving at least 10% of your income, fundamental financial control is ultimately yours. So save no less than 10% of your income. And that for those that are just starting off and are not currently saving, that may be a tall order to say, okay, we're now going to divert 10% towards your future. So once you start the process, you'll realize that it becomes easy. You may want to start with saving a smaller amount than 10% and working yourself up to that. If you're starting later in life, then you're going to have to start saving more than the 10%. Having a disciplined approach to saving is paramount. Pay yourself first. So systematically putting money into your savings is going to go a long ways. One of the ways that you can save is by putting money into your employer's retirement plan, like a 401k, 403b, that like Jason had mentioned, particularly if they offer a match. If your employer is offering a match, then that is free money. You want to contribute up to that match without a doubt. And then from there, look at alternative options, but at least save up to the match of your employer's retirement plan. One of my favorite accounts is the Roth IRA. As Jason mentioned, the tax diversification that you'll want in the future. This will provide you with some tax-free income. It also gives lots of flexibility. So if you qualify, consider a Roth IRA. Rule number 2, gold laboreth diligently and contentedly for the wise owner who find for it profitable employment, multiplying even as the flocks of the field. So what is this? This is compound growth. So just another look at it, because it is important. As Jason mentioned his reference to Albert Einstein, who's, as we all know, a very smart person. Saving can themselves grow and compound your wealth. The earlier you start saving, the better off you're going to be. You can see in this chart how somebody starts saving early. They're going to have much more at retirement age, and it's going to grow exponentially. Rule number 3, gold clingeth to the protection of the cautious owner who invests it under the advice of men wise in its handling. So seek professional advice. Your savings will be more protected if you seek advice from professionals. Does it make sense to ask a computer tech to diagnose your ear infection? No. So you want to go to somebody who's qualified in the areas that you are seeking, whether it be investments, financial planning, tax strategies with a CPA, as well as estate attorneys, but going to the professionals. Not all professionals are the same, so shop around. You want to have a financial professional that you feel very comfortable with and that you trust. Voice your intentions. We cannot help you unless we really understand where you're coming from, what you're looking to accomplish, and where you're heading for the future. So it's a two-way street. We want to hear what your needs are, so we can advise accordingly. Rule number 4, gold slippeth away from the man who invests it in a business or purposes with which he is not familiar or which are not approved by those skilled in its keep. Yeah, that's a mouthful. So what does that mean? Is really in a nutshell, due diligence. Savings will diminish if it is placed in investments as a person is not sufficiently educated. So really understand what you are investing in and why, how it's going to get you to your future financial goals. Read the fine print of any investments, understand what you're getting yourself into, and make sure, like I said, that it fits in with your overall goals. Rule number 5, gold flees the man who would force it to impossible earnings of tricksters and schemers who would trust it to his own inexperience and romantic desires in investments. So what does that mean? So savings are easily lost to those who are wooed or not realistic on the investments they select. If it is too good to be true, it most likely is. So try and avoid the get rich quick schemes or being overly aggressive in your investments. You should understand your timeline. If you're younger, then you can afford to take on more risk, but what type of risk is appropriate as you get closer to your retirement goals or your other goals, you want to taper down that risk and be more conservative. Another way to reduce your risk is don't put all your eggs in one basket. So the importance of diversification. One thing that you could do to identify how much risk would be appropriate for you is take a risk tolerance questionnaire. Review that risk tolerance. It would change over time. You may be, as your situation changes, such as purchasing a house, marriage, children, entering retirement, so these different stages of life, then your risk tolerance may be changing as well. This is just a chart going back to 1926 of the different returns based off of whether it be stocks, bonds, bills, or inflation. And so you could see that inflation since 1926 has been around 3%. Your investments that you have will want to outpace inflation. So going back to compounding is you want to get a return, because if you're saving it, the way to increase your wealth is to have those savings multiply. And the way to do that is through investments. And so if you're investing in very safe treasury bills, you can see that the average return is about 3.5%. So just a little bit above inflation. Very conservative. This may be the way for you. Next above that is government bonds. They're averaging about 5.5%. Large cap stocks averaging about 10%, and small cap stocks averaging about 12%. So you can see getting just a little bit of a higher return over a longer period of time is going to go a long ways. But as rule number 4 indicated, if you're trying to put your money to get a return that is beyond what is expected, then you run the risk of losing that money. And so you want to invest with caution. So thank you for your time. There is my information, my email address, if you'd like to get a hold of me. I encourage you to if you have any questions for Jason or looking to want to pick his brain for financial advice, to contact Jason's.
Hey, flip the screen back, please. Thank you. There we go. So before we get to the questions, here's a list of everything that Chris and I do as financial advisors. So you get a better understanding that we help a lot of people There are all these different parts of the puzzle that we talked about earlier. So keep that in mind. You know, if there's something out there, if it's a dollar sign attached to it, we can provide information for it. We know somebody that could help you. We probably can help you, and we know a direction to point you in to get things accomplished. Time for questions.
Well, I'll start it off. I mean, wow. That's all I can say for right now. I mean, that was a lot of information, Jason and Christopher. Ton of information, and I greatly appreciate it. One of the things that I want to talk to the audience about, Jason had mentioned, save $500. Well, I don't have $500. That's what Jason and Christopher probably hear on a regular basis. I don't have $500 to save. Well, one of the things Jason also mentioned is if you come to see him or Christopher, and I do this as well, but they're our guests, they sit down with you and they put down together a plan. They'll sit down with you and they will ask you questions. And more times out of not, you will answer your own questions. They will answer your income. They will ask you your expenses. And they will ask you your expenses right down to the minimum. That minimum might be, how often do you get your nails done? How often do you get a haircut? Because they want to know your habits. And one of the things that may come out of it, when you look at that, you might be able to assess and say, oh, wow, I can come up with $500. Because Starbucks is about $5, $6 for a latte. And I have friends who would buy 2 or 3 a day. That's $15. And you do the math, $15 a day times 365, you're close to $500. Chris and Jason are not asking you to give up your latte, but you might be able to say, if I'm going to make my goal, I could give up 2 lattes. One of the things that Jason had mentioned is diversify. He talked about taxes. Chris talked about the history. I loved him using the analogy of gold. A lot of beliefs that we have and a lot of rules we have come from the Bible, the 10%. Diversify. You're going to have to pay taxes, but there are instruments out there that could minimize your tax. And I love the one that Jason had on there, the illustration, the $120,000 tax, and you wound up with a net of 78,000. If you still wanted 120,000, take it from 3 instruments, and you have income of 100,000. That's $22,000 difference. I don't know about you, but I could use $22,000 a year difference. One of the things we talked about in our presentations, this is for the benefit of Jason and Christopher. We don't plan. We don't sit down at the kitchen table. We don't even sit down at the kitchen table and talk about our own final expenses. Jason and Christopher could help you with that. One of the things Jason and Christopher talked about is, do I outlive my money? Or does my money outlive me? Look at this conversation as, how can I get my money to work for me? If I put it in the bank, I receive 0.035. There are instruments out there, and Jason and Christopher said, on average, 6 to 7% on $100,000, that's $6,000. Think about that. Emergency fund. Again, we talked about that in a previous session. Standard is 6 to 12 months. But if you were around in 2006, 2007, 2008, even now with the coronavirus, some of my friends are still unemployed after all of this time. One of the questions I have, Jason, for you or Chris, and I think you mentioned it, how does life insurance fit in my portfolio? Because people say I don't benefit from them, and we're going to have a program on this, everybody, next week. But I have to die to benefit from my life insurance. Is that true?
Yes and no. And there's a better answer for it. So of course, with life insurance is there to insure a life. That person passes on, then it goes to the beneficiaries as listed. But there are multiple types of life insurance policies. For example, you could have a hybrid policy that combines long-term care, life insurance. So instead of using the life insurance when you're dead, you have a long-term care event, you could exhaust that while you're alive to pay for your long-term care event while you're here. Or if you have a long-term strategy and you have enough money, you can put money away. Let's say you put money in a cash value life insurance, multiple, like a variable universal life or index universal life for 10 to 20 years. You can begin withdraw that money tax-free, the cash in there, so you can supplement your income. So there's multiple uses for life insurance. It can also be used to protect a specific asset. There's multiple types of different life insurance, whether it's a term insurance or cash value or universal. So for example, if you had a term insurance and you said, oh, I just got a mortgage that's $500,000, I got to make sure that's paid in case either I pass away or my spouse passes away, then you'd get and it was a 20-year loan, you'd get a life insurance term policy for that 20 years to cover that, just in case something happens to either one of you. You help offset that with negative effects of your death by having that asset paid for.
Very good. Very good. So does anybody else have any questions? Well, on behalf of the 100, Rhonda, are you there? Nice picture, Jason.
Thanks.
I am here, and I just want to ask one more time for our participants here today. If you have any questions, please place them in the chat, or please raise your hand, or if you have any questions. If you are watching us live on Facebook, if you have any questions, please put them in the comment section. We'll give you a couple minutes to make your determination.
And Jason, FYI, if you want to take me out to golf, because I looked at your bio, I'm 13 handicap.
2 handicap. Are you playing for the Red Tees?
13 handicap.
Oh, 13. Okay.
Dang, man. I just met you. You said, do you play from the Red Tees? Dang.
I go right for the gusto. You asked.
There you go, my brother. I like it. I like it.
Well, fantastic. We don't seem to have any questions today. On behalf of the 100 Black Men of Las Vegas, we'd like to thank everyone who came out today to the Manage Your Money workshop. We'd also like to thank our presenters, Jason and Christopher. You did a fantastic job. Thank you for spending your Saturday morning with us. And also to our community partners, we could not do this without you. Nevada Partners, Coalition of 100 Black Women, the Urban Chamber of Commerce, the Las Vegas Urban League, Bank of Nevada, Wells Fargo, and of course our own 100 Black Men of Las Vegas. Thank you very much for tuning in to Manage Your Money Workshop week number 7. We look forward to seeing you next week. Have a very happy and safe Memorial Day weekend. Good day.
Thanks, Jason. Thanks, Christopher. God bless you and your families.
Have a great day. Have a great weekend. Happy Memorial Day.
Thank you, Rhonda. Thank you, Daryl. And thank you all those that are attending. Happy Memorial Day.